So there are a lot of people who are predicting a lot of things about what's going to happen in the world with the economy. Uh, there's a lot of people predicting a major crash. There's a lot of people who mostly have the same political leanings who are predicting that we're going to have a massive economic boom expansion because they think all the policies that have been put in place are going to create that. Um, I've recently, I read the news, mostly business, political, science, things like that. Every day. One of the first things I do in the morning while I'm drinking coffee is I just do some reading to stay up on current events. Um, and I also am always reading and or listening to usually both. I'm usually listening to and reading one physical book. Um, and I've recently read Housing Boom and Bust by Thomas Sowell and 1929 by Andrew Ross Sorkin. Both of those books are, the Thomas Sowell book is more focused on the economics that behind and the policy decisions and things that happened prior to the 2008 recession, um, and trying to determine a cause. Um, Whereas the 1929 book, I was kind of hoping for something similar because the reason I chose to read these two books is because I want to know or try to predict where we're headed. Um, and the 1929 book is more, it's very interesting, very, very fun read, but it talks more about the politics, it talks more about the news and the public sentiment and all of that rather than sort of the underlying economic causes like Thomas Sowell gets into. Um, there's been numerous other recessions, crashes, booms, busts, bubbles, all these things that have happened throughout history of both the United States and the world before that. Um, and I think that what I've realized is there is no way that you can really predict these things. I think Warren Buffett does a pretty good job of knowing like when valuations get too high in general. Um, like right now, the price to earnings ratios in the major stock indexes are crazy, crazy high, like in the 30s. Um, the averages are in like the 18 to 20 range price to earnings ratio. So, and that's I think why Warren exited a lot of his positions and has built cash over the last couple of years. Um, Real estate's a little harder to predict, which is the area that I focus on, and you know it's it's been pretty predictable generally outside of 1989, 1990, 2008, 2009. Real estate generally just creeps up slowly in value. It does not appreciate at rapid rates. Typically, that's been typical. That's not been the case um, as much in the last 20 years or so. From 2005, 6, 7, you had lots of big appreciation. And then 2008, 9, you had lots of deflation, like 10% national average each year, which is the most real estate has went down since they've been tracking this as a national metric. Um, and then we've had this massive expansion in value from 2020 to today, really from 2020 to 2022, and then it's kind of either stabilized or in a lot of markets has dropped off in value a little bit. So what I think I've realized though is you can't necessarily know where the world is going, and you shouldn't have an investing strategy that relies on you guessing correctly about where the world is headed. So my thought process is I'm a real estate investor, and I'm going to do deals that conservatively underwritten, conservative use of leverage, um, conservative rent projections, still survive through a downturn, still survive in an area, in an era of depreciation in the values of real estate. Because if you're relying on the values of real estate going up, I feel like you're just speculating. What I'd like to do is buy things that I know, even if they lose 20% of their value, well, I could still exit. I could still get cash out. I could still, um, even if rents go down by 10, 15, 20%, I could still cover debt service on the debt service that I have on those deals. Those are the kind of deals I want to make sure that I'm in, or that I'm getting into at this time. And I also want to try to do a really good job of maintaining liquidity and access to capital right now, so that if the market does take a little bit of a downturn, which it already has in a lot of areas, in our Florida markets, I'd say right now is a pretty good time to be looking at making some investments. Some of those markets have dropped 20% in value since the peak. Um, you know, that you're in a position to be able to take advantage of those type of situations in certain areas, certain markets. So that's what I'm doing. I'm staying consistent. I'm still investing. Just a little more conservative underwriting. A little more thought towards the downside, and just keep moving forward. Keep owning assets that produce income.